Eric will kick us off in a moment, but our hope is to make this conversational, not get lost in too much of the jargon, and there's lots of it in this topic. So just by way of introduction, I'm Eric, this is Kevin, and Uliana. We're all advisors at WellSpire. So thanks so much for joining us. Today, we just hope to have a conversation about equity compensation. So Kevin just mentioned there's a lot of jargon that gets thrown around, restricted stock units, incentive stock options, non-qualified stock options, employee stock purchase plans, all of which have acronyms. A lot of technical stuff that gets mushed together there. But our hope today is to have a conversation a little bit less on the technical side, a little bit more on just frankly, the emotional side about how people tend to think about their equity compensation, why it feels a little bit different than just getting a cash bonus, but maybe it shouldn't feel that much different. We'll get into that a little bit. And we really want to just help you identify patterns that we've seen over time in our careers and in our work, help you think through that and kind of create this framework within which to make decisions. This is a great time to have this conversation. Spring, many people are just coming off of kind of their bonus season, ending year-end reviews. Taxes are coming up, so a lot of questions come up from that as well. Definitely want to make this an interactive experience, like Kevin mentioned. So please feel free to ask questions. We'll get to them as we can. But with that, I'm going to turn it over to Uliana just to walk us through how we're going to do the rest of this webinar.
So just to kind of outline the process for today, we prepared three real life scenarios that happen pretty often in our practice with working with people who receive equity compensation. So we'll try to be, very structural, not too technical, and hopefully will be easy to follow. So for each case scenario, we set up the story, kind of identify the key decision topics that needs to be made, and outline the most common questions we hear from our clients. And I think most importantly, how we think about it as advisors and how we help our clients to navigate through those scenarios. So with that in mind, feel free to post your questions. I hope you relate to those case scenarios. We can address your questions as we go or leave them for the end of our discussion and kind of compile. Well, we want it to be dynamic. We want it to be real. So with that, I'll turn to Kevin and, let him present the first case.
All right. Thanks, Liliana. So my case or scenario is going to be about Sarah. Sarah is the VP of engineering at a company. She's been there for 9 years. She's gotten stock grants in whatever form over that entire period of time. Doesn't really matter the type. Now she's turning around, looking at her balance sheet. She's got 60% of her net worth tied up in company stock. For this purpose, let's assume it's publicly traded. This can come up for private companies, definitely. This a lot of the same logic and points that we'll share apply, but it's just more realistic and you have the liquidity, let's say, in a public company to do something about it in an easier fashion. But keep that in mind. And third point, all of a sudden, the stock drops 25%, which for a single publicly traded stock is not at all unheard of. Can happen multiple times a year, even in a year when the market is up, single double digits. So those 3 points. So first point to make from that is 60% is pretty high. It's a pretty high concentration, but it also depends on the context of the person we're speaking to and their goals. How old is Sarah? What other dependents or expenses does she have? For example, if she's in her early 30s, she doesn't have kids or dependents, she rents maybe in a bigger city. We would argue probably 60% is still kind of high, but maybe 30-40% is okay. Maybe
Yeah.
that's a reasonable level for her.
Yeah, and I mean that's a conversation I have with people all the time is like how much should I have within my company stock? And I think it definitely varies by person. But overall, I tend to lean on if you're involved with the company in a meaningful way, you're probably going to have a larger concentration than if you were just buying the stock off of the exchange. And I think that that's okay, but there's still a lot of risk tied into that because you have to think, if you're working for a publicly traded company, you have a high percentage of your net worth tied in the stock's not doing well, maybe that means the company's not doing well. Now, suddenly, not only is your portfolio under major stress, but then also potentially your income source as well. If the company has to go through some type of layoff situation or something like that. So that's typically how we try to frame that conversation with people and just help them think about that before we jump into a scenario where it gets to about a 60% plus level of their net worth.
Yeah. So Eric Uliano, what would you say is a reasonable concentration level for, let's say, someone who's in their 40s, they have one or two kids, they have a home, they have a mortgage. What should they be goalposting as, maybe a percentage to aim towards?
I think, honestly, there's no a cookie cutter answer that tailors to all. But in general, when we look at concepts of concentration, I think, target of 20%, that's kind of what we would look at, and deviate from that based on upcoming larger expenses, life goals, other things. Once again, we need to see the full picture to determine that number. But as I said before, like let's look like 20%. I think it's something we can manage with.
Yeah, my brain went 25%. So I feel like that's a higher, again, in my mind, that's a higher concentration than somebody who has absolutely no connection to the company whatsoever,
Yeah.
but still is not to this level that Sarah got herself into.
Exactly. So, I think to wrap that point, it's the same portfolio or concentration can be pretty reasonable for one person and not for another. So, as the common thread here is that the details matter. So I'll shift to a common question that flows from this kind of scenario, and that's often we hear, okay, my stock dropped 25%. Should I sell now after it's already dropped, or should I wait for it to recover?
I mean, I think the problem that kind of underlines is we don't know if it's ever going to recover. And I know that that's kind of scary to say out loud sometimes, but I think the emotional concept that you're talking about is anchoring. Is that right, Kevin?
Yep.
So, we as humans tend to put a lot of value associated with something of when we receive it. And we think that, because something's happened in the past, obviously it's going to happen again in the future. And that very well may be the case, but it also could very easily not be the case. And so we really want to kind of break that hold, I feel like, and think about the situation afresh every single time we have a discussion about the position and not get anchored and drawn down to something that's happened in the past.
Like I like to ask my clients the following question when something like this comes up. If you have a cash equivalent of the position, whatever it was now, within even with the 25% decline, will you go on the stock market and buy that stock?
Mhm.
So that kind of gives you the answer. Like if you believe in the company, you think, okay, like this is what I will be buying right now. This is a great buy opportunity. Sure, like, we can hold on and ride out the decline, but at the same time, if you say like, no, I'm not sure if it's ever gonna come back, that's a point for new discussion. So should we rebalance and move out?
Yeah. Agree with all those points. And the only other thing I would add is that question implies, should I sell now and wait, sell now or wait until it recovers? That implies that it's an all or nothing decision. And we, in fact, know that it doesn't need to be, particularly in this scenario with 60% of your net worth. We know it should probably be lower. Doesn't mean we have to do it immediately. It could be prudent to do it quicker than not, but doing something is better than kind of riding the inertia and not doing anything about it, which people that it's a human response. It definitely happens and is a natural reaction of being in a situation like that.
Yeah, and that just sparked in my mind, Kevin, a conversation I have with clients all the time is we always want to be intentional about the decisions that we're making around equity compensation. It should never be, well, I just didn't really want to think about it, so it is what it is, and oh, it's up today, let's sell it today because it's up. Like no one here at this side of the table or anywhere knows what's going to happen because if we did, we'd be doing something else, we'd be making a lot of money. But the idea is that you want to set up a structure in place so that when moments like this happen, you can react within a framework and it's not all an emotional decision right off the bat every single time that it happens.
Right. So there's one more point that Eric alluded to before I want to make explicit for this scenario that is going to apply to Eric and Leona's scenarios, I'm sure too. It's that concentration risk that we're talking about here. It's not just the stock itself, right? Especially for someone who's an executive or an insider of your company, you might be required to have some level of stock in the position if you're really high up on the company's board or executive suite, so to speak. You have salary bonuses tied to the company. Your future equity grants that you are presumably going to keep receiving are tied to the company, your career, longevity. And so all those three things on top of the existing stock you have. So and I'm sure you guys do the same, when I try to tell people to diversify, de-risk a bit, the conversation often goes to just remember, you're going to still have additional ties to the company directly or indirectly. So it's not as if we're severing all positions.
Definitely. And I'll just add there, I think it's really helpful for people when we build out a vesting schedule for them to look at visually and to think not only what do they currently have within their accounts today, but how much future exposure they've already been granted, and then thinking about additional grants that'll come in over time as they continue to work for the company. And I think that can also help change people's perception about how much they should be keeping of their available liquid net worth within a single name.
Right. So a lot more we could probably talk about on this topic, but I want to be respectful of everyone's time. And uh, Eric, one thing that comes up here, and it ties to what we've talked about so far, is clients wait because of emotion. They don't have a strategy laid out. Their inertia is a powerful thing, but it's also taxes come up, right? We haven't even touched on that. It's easy to talk about, oh, just sell your equity. Well, okay, if it's at a large gain, there's a tax bill to pay. So taxes can create a blind spot. So can you walk us through the next scenario that touches on that a bit more?
Yeah, of course. And thanks for the setup. Really appreciate it. Yeah, so taxes are always a factor in everything that we do, but I always try to tell people, it shouldn't be the factor, the only deciding thing that prevents us or drives us to do something. It's one among many that should always be considered. And I know this is going to sound weird, but paying a tax isn't necessarily a bad thing. It does mean that there's been some appreciation, some gain. You've earned something. So we want to mitigate that as much as possible. But at the end of the day, sometimes it's the right thing to do. But on the topic of taxes, just touching on that, I'm going to introduce our next case scenario. So we have James, who is a senior director, again, at let's assume a publicly traded company. The situation is he had a $500,000 restricted stock unit RSU vest occur. As a result of that, there was a flat 22% federal withholding that applied. And lo and behold, when he decided to go talk to his accountant and file his return, it ended up that his implied rate was much higher than that. So it kind of faced an unanticipated tax burden. And I think really what this is highlighting is the idea that sometimes we can get trapped into the idea that because the company is withholding taxes or something has already been taken out, that that's the end of it and we don't need to worry about it anymore. And that may be the case depending on your particular individual tax situation, but oftentimes it's not. And you really need to think about liquidity planning in addition to just the equity awards that you receive. So in this instance, I'm going to get a little technical, trying not to, but the way that RSUs work is as they vest, that equals whatever the market value is at that moment of vesting, is taxable ordinary income to you as the employee. So you're fully taxed on the market value of the RSUs as of the date of vesting. That also creates your cost basis in the RSU. So if you immediately sell them following vesting, there's no additional tax owed. There's no advantage to holding them longer. If you sell them at the same price that they vest for you, that's it. So I think a lot of people sometimes get tripped up with this idea of like, I have to hold these, or there's some reason to wait to sell them. I want to wait a year for it to become long term. That really doesn't apply to RSUs. So that's a great moment in time to think about, hey, there was this 22% automatic withholding. I think my tax bracket's going to be much higher this year because of, the state and just other income that I've received. Like, let me sell enough shares right now so that I know that my tax burden is taken care of. We'll put that aside into a cash equivalent, a treasury, some money market fund, something like that. Let it earn some interest, and then when the bill comes due, it's there and I'll pay for it, rather than kind of scrambling at the end. It's also a great opportunity to diversify and think about your long-term strategic holding over time. So I don't know if you guys have been in similar situations with clients about that.
Usually when, we talk about RSUs and clients' portfolios, I think system works and, immediate advice is, let's sell at vesting and see what we want to do with proceeds. And that incorporates keeping some cash, on the sidelines for the tax liability due, as Eric was mentioning, and then, reinvesting the rest. Sometimes, clients are attached to their company. We want to hold some. Once again, it goes back to our previous conversation on concentration, like to what extent we want to keep it. But bottom line is, let's sell at vesting and let's, account for the tax payment due. And this is kind of triggers another conversation because, we understand our client taxes, but that's where we get involved with the CPAs and, trying to see the full picture. So whether there's quarterly payments needs to be made, other things. So that's a teamwork going forward.
Yeah. My only additional point was going to be something that I think Uliana indirectly already brought up was it pays to remember, it's helpful to remember that, and Eric made this point too, you've already been taxed on the RSU income. It is as if someone handed you $500,000 of cash, you went and bought your company stock that same day. So if you are comfortable having that amount of employer stock, great. That fits within the rest of your goals, your cash flow needs. You can pay the tax without selling, okay. But if not, you should ask yourself the question, am I comfortable forking over $500,000 and buying that amount of employer stock? Because that is what you have done. And it's easy, it's a publicly traded company. Let's assume you either can trade it at all times or you're within the window if you have a trading window to do it. That's the time to reconsider, and make a plan. And in our experience, or my experience at least, people just simply, it is easier to not act and take some step to, freeze to sell and do something than kind of hold. And again, very rational human reaction to have happen.
Well, I don't know if it's a rational human reaction, but it's very human. It's a very human reaction. Yeah, I think, oftentimes when I have conversations with clients about this, it lands a lot on a little bit of fear. I feel like fear of missing out, or they think about other times in the past, either with their company or maybe a friend, a colleague, family member who, just always held onto the stock and it ballooned and, it's great. And that was a great story. And I feel like that there's some innate sense of well, I got this, I can keep it, and then maybe I'll get more. And, I would pose the question of that's very true, but, how would you feel if it went the other way? Because typically we're wired, again, as humans, to really, really hate loss as opposed to feeling the joy of gain. So, again, to Kevin's point, it's a great one. If you got that as cash, would you suddenly turn around and invest 100% of it in this exact same stock? More likely than not, the answer is no. Probably some of it, right? And that's where the conversation starts about keeping it.
And to build up on, Eric's discussion on taxes, I think we can smoothly transition to our case number 3. Unfortunately, I don't have a name for that person, but imagine someone who started with the company early on, build up a significant exposure to ISOs and NSOs. It's a private company. Rumor has it, and the company's doing great. Rumor has it there will be an IPO within the next 12 to 18 months. And, the first question that comes to mind, I have all this great value built up on paper. Should I do anything about it? Should I exercise early? And clients come to me with this question often. saying like, and why would you, the first question is, why would you want to exercise early? And it ties to the tax discussion, really. Once again, like I also gonna get a little bit technical here, but I think it's important to understand the taxation process on the stock options versus restricted stock units. So at the moment, you get granted the stock options, nothing happens. You just have a grant, there's not a taxable event, you have a record somewhere, so you have all this value for you at the future. But at the moment you exercise the stock option, a few things happens. It's not exactly a taxable event to you, but on the moment of exercise, the difference between the stock option strike price and the actual stock price value, that bargain element, what we would call, is considered as income for the alternative minimum tax income calculation. So we have thresholds until, if you hit that threshold, like if you're within the threshold, you're not exposed to alternative minimum tax. But if you exceed it based on your own, tax situation, you will be liable to pay taxes. So that possibly a taxable event. And then at the moment of your exercise, you buy the stock, it becomes your cost basis. And then it's a question how long you're going to hold it for. If you sell it right away, you might have some short-term capital gain tax exposure. If you hold it over the year, it will be a long-term capital gain. So long story short, why would you want to exercise early? To kind of avoid the potential alternative minimum tax exposure, just because it's a private company. There is no stock valuation yet. So you will take the valuation for calculation from 409A form that you have. And typically it's much lower than that's what anticipated in the market at the day of IPO. So you kind of minimizing your AMT exposure, and then you start holding stock position for longer times, so potentially being only exposed to long-term capital gain. So at this point, you are very thinking like you're not only dealing with taxes, though. That's what I'm trying to bring to my clients' attention. You're dealing with taxes, risk, and uncertainty. And that's a lot of things to handle. So, and if you think about it, putting all this and you're working with cash that you don't have from this investment yet. So you have to come up with your own funds on the side to exercise those stock options. And the question comes whether you really want to spend that money and expose yourself to such a risk. So questions then comes to you as a client, like I would be asking you whether you're willing to lose this much money in the future. What if IPO never happens? What if the stock tanks at the time, and you never gonna keep the valuation or recover what you put into it? Bottom line is there's not like a all or nothing discussion. It's something in between. So we need to decide what works for you personally by looking at the full picture. And it comes back to our discussion of setting up a full framework, understanding your goals, understanding your current liabilities, where you're in life, what is expected, and then drive our decision from that.
Just to recap a little bit for everybody, I think we were referring mostly to ISOs, right? Incentive stock options. So if you grant me 1,000 shares in Uliana Corp, there's nothing, I'm not taxed on anything, right? At the grant. No grant. Okay. So if I decide to exercise my options in Uliana Corporation, let's just say they're worth $100. I exercise 1,000 of them, $100,000 of income, right? Mm-hmm. I guess the answer there is it might be taxable to me now, right? That depends on the AMT calculation, alternative minimum tax. That gets a little bit beyond the scope of what we want to talk about today. And the only thing I guess I would contrast that with the audience is everything I said applies, but if it's non-qualified stock options, so now we're referred to as NSOs, that exercise is definitely tax I have to pay. Mm-hmm. So nothing at grant. Uliana grants me 1,000 shares in a corporation, nothing I have to pay. I then exercise them, $100,000. I am absolutely going to pay tax on that. And I think it's also withheld. Is that right, Eric?
When you say you're talking about
taxes withheld.
Yeah, so it kind of depends. And I think Uliana talking about pre-IPO private company adds a very interesting lens to which to have this discussion, because everything up to this point has been basically focused on public equity. But obviously private equity, not having a really ready liquid market, it removes things like cashless exercise often. It does remove the ability to automatically withhold for income tax for the execution of like
True.
NSOs and things like that. So when we're in this realm of private equity options, oftentimes I'm telling clients, if you have the ability to, one, have the liquidity to invest in the company early on, and two, your plan is such that you can handle not having access to those dollars for an extended period of time that you've put to work, exercising private equity options sooner rather than later tends to be the smarter tax play. Because if they're ISOs, there's some holding requirements that come into play. You start working the clock on that. You'll have a longer time for AMT recapture. So that's, again, not want to get super involved in that just here, but there are more tax advantages to it. And to Leon's point, oftentimes you have a lower 409A valuation. So the spread between your strike price and the fair market value is much smaller, which means your potential tax liability is much smaller. The other time is the exact scenario that Leona brought up is there is an IPO on the horizon. You can kind of take advantage of a slightly lower valuation than what's expected post initial public offering. And you don't have to wait as long for that liquidity event to happen. So that tends to be the other point in time that people really think about exercising these options for sure.
Cash reserves matter once again, so there's always a risk for early pre-IPO exercise that you'll pay the tax and then never materialize your shares in the future. So we have to take that risk under consideration.
The only thing I would add to that pairs well with everything Leon and Eric have said is I try to frame this as a decision point between minimizing your tax on one side and minimizing your risk uncertainty on the other. So you could, in theory, if you're granted ISOs, NSOs, whatever the case, you could immediately exercise as soon as you're able to. That could cost, that costs you the purchase price of the shares. That could cost you some tax to pay, but minimizes the tax you will pay if the company grows as fast as you expect it to. The other side of that coin is, okay, I don't really know what's going to happen. I have cash constraints. I don't really have the cash to pay for all this. I just want to deal with it. You could wait all the way up until the IPO if one happens, and yeah, you'll pay ordinary income tax, but you will not have had to shell any of your own dollars out. So that minimizes your kind of risk and uncertainty on that point. Now, those are two very drastic extremes. I think, and what Eric was getting to is a lot of our clients are often going to be in the middle of those two scenarios. So it's trying to find the balance that is kind of the art versus the science of what we do.
So actually, we did have a question come in. If you want to hold some of your employer stock, what would you recommend as an appropriate amount? I think, typically we ground that conversation in thinking about a percentage of your overall net worth. So rather than any fixed dollar amount. And then it comes in terms of kind of what do you want to accomplish? What are your short-term, medium-term, long-term goals? What's your appetite for risk? Generally, it's more of a conversation there. I think we all kind of landed at a maximum, just rule of thumb, pick it out of the air number of 20 to 25% of your total net worth within employer stock. But I want to turn it over to Juliana and Kevin to jump in as well.
Yeah, I think 20 to 25%, if you're tied to the company, you're not just someone. I would frame it as we come across people who have 5 to 10% of a single stock that they're not at all tied to.
Right.
That's pretty common, and we try to advise them to keep within that limit. If you have some ties to the company, you have some skin in the game, it's natural to want to go beyond that amount. So 20-ish% kind of makes sense to me. I would just add, if it's a private company, it can be harder to keep that level. You just don't have the controls in front of you you don't have the liquidity. You might have a tender offer come up to offload some things, some amount of the shares, but you just don't have the ability to minimize it. And often in a private company, part of the appeal, the gamble you're taking is sacrificing some salary for some additional upside. So it can be okay to go beyond the 20%, I would think.
Yeah. And I mean, I think what you were kind of alluding to, which I agree with, is the difficulty of valuing a private company sometimes
That
makes it
too.
hard to back into a calculation like 20% of your net worth. Maybe it's much higher than that, but we don't really know.
Yeah. But the last point I was going to say is stress testing is kind of the key to all this. I mean, I think we can all imagine scenarios, all three of us, where 20-25% is probably more than you want to take if the modeling and the stress testing we're doing shows that you can't afford to send your kids to the college that you want. You can't afford to take the vacations and spend on the things you'd like to. So it really is in furtherance of what goal or goals does this concentration allow or not allow you to accomplish?
So once again, comprehensive approach. You need to look at everything that touches your money to come up with a one defined solution. There is no one golden answer that fits all. Financial planning becomes very essential in conversations around incentive comp.
Eric, there was a point you were talking about in your case study of withholding and like some of the rules around that and $500,000 RSU vest, it might be insufficient. You want to maybe just expand briefly on that, like at a high level?
Yeah, sure. So there are regulations in place that mandate at a federal and a state level, many states have these as well, of how much needs to be withheld from an RSU vest or other type of like single liquidity event bonus type situation. So at the federal level, as if that event is less than $1 million, the automatic withholding is 22%. If it's $1 million or more, I believe it's 32?
37.
37, thank you. 37%. So a state like New York, the automatic withholding for the state is 10%. And then if you're also a New York City resident, I think it's an additional 4 on top of that.
Yeah.
So you're looking at 14% just for New York as a New York City resident. Just continuing on that vein, oftentimes the withholding at that level at the federal for someone who's having a large liquidity event dealing with an RSU is too low, and the withholding at the state level might be too high. So you get a little mismatch there, and it's just about thinking about, hey, maybe I should talk to my tax preparer or my financial advisor about this transaction, think about should I be making quarterly estimates, which the main goal of doing that would be to avoid an underpayment penalty. I tell this to people all the time. If you owe taxes in April, it's not a bad thing. You just don't want to owe penalties and interest, because owing taxes means that you've kept those dollars in your pocket for that period of time and hopefully earning something in terms of interest and things like that. So that's where that planning can kind of really come into play. Yeah, so just kind of a couple of closing remarks. One of the things that I really see a lot and would want people to take away is that a lot of the angst that comes with employer stock, kind of single stock positions generally, is this inability to create a system within which to operate. It's always going to be emotional. We're not robots. We're not going to be able to fully weed all that out of ourselves, and nor should we. But having some framework within which to think about and make decisions can really, really be helpful because, again, it grounds you in this idea of what do these dollars really mean? And what does that mean for me and my family? And how should I be thinking about my future as it relates to this compensation that I'm earning? So it's really, really important in my mind to have that structure in place so that you can kind of ease into making these decisions as opportunities come up.
What I tried in my own life is to systematize as much as possible. And that's, I think, Eric, in a way, what you're talking about here. If you can come up with an approach that takes out as much of the emotion out of your own hands, because we all feel it. Let's be honest here. We're, even as professionals, or purported professionals, hopefully, we feel the same emotional pangs that everyone else feels. When the stock market drops, we get uncomfortable. We just try to get out of our own way, and I think a lot of that is trying to set up a system to do that.
Yeah, I think it's helpful to work with the professional, with the system, because you can always bounce your ideas, kind of understand the technicalities of the process of the incentive comp, and that's where the financial advice becomes very valuable. Sometimes you don't know what to expect, so planning ahead, having a system in place, is very beneficial.
We didn't really talk about employee stock purchase plans at all. So just in my mind, they're a nice way to gain some exposure to employer stock at a discount. So typically that's between 10 to 15% off of the posted value of the stock during a set period of time. You invest a certain amount, it gets averaged in. That comes with some tax advantages as well if you hold it long enough. I think it's 2 years, 2 years from grant, 1 year from vest.
That's correct.
Okay.
Right. So the real way that I talk about that with clients is almost like a hamster wheel type of thing, where you set it up at the beginning, you invest a regular amount over time, but once you've squeezed out the full tax advantage from the SPP, you embark on a regular sale program. And as that 2 year mark anniversary keeps coming in, you sell those shares and you diversify it into your portfolio. So you're really just doing it a little bit more as a tax play rather than a way to really materially increase your exposure to your employer stock.
The only thing I would add too, I've even seen people do it where they don't even wait for the 2 year, and that's intentional. You'll pay a higher amount of tax, sure, on the gain, but if it's a 15% discount, and sometimes there can be look back provisions where it's even more generous than it sounds. Some people use it as almost a forced savings device to, not only save throughout the year, manage their cash flow, but also get that discount kind of locked in immediately. And look, in theory, this doesn't always work. There's volatility in single company stocks that can happen, but done often enough, that can be just as reasonable as an approach too.
All right. Well, again, so thank you so much, everybody, for joining us. Hopefully, you got some interesting ideas out of this. Welcome. If anyone has any additional questions, please feel free to reach out to us. And thanks. We'll see everybody again.
Thank you.
Thank you.